A $10,000 emergency fund sitting in a standard savings account is losing roughly $200 of purchasing power every year. Not through fees. Not through bad decisions. Through arithmetic. The average savings account in the United States currently pays around 0.5% in annual yield. Inflation is running at approximately 3%. The spread between those two numbers? 2.5% is the annual real loss rate on every dollar parked in that account. On $10,000, that is $250 gone per year. On a 6-month emergency fund for someone earning $60,000 annually, the balance might sit at $15,000. That is $375 in annual purchasing power loss. Invisible. Unnoticed. Compounding in the wrong direction. By the end of this, you will have the exact calculation for your balance and a 3-tier framework to narrow that loss without touching your access speed. The loss calculation? The math is straightforward. Current average inflation sits near 3% annually. The average interest rate on a standard savings account, not a high-yield account, the standard product most people are issued when they open a checking account, hovers around 0.4 to 0.6%. Call it 0.5% for clean math. The real yield on that account is negative 2.5% per year. That is not a projection. That is the current spread. Apply it concretely. A 3-month emergency fund for someone with $3,000 in monthly expenses holds $9,000. At negative 2.5% real yield, that account loses $225 in purchasing power annually. A 6-month buffer, $18,000 loses $450 per year. Every year. While the account statement shows a balance that appears unchanged. This is not a warning. It is a description of what is already happening. The loss is not theoretical. It is present in your account right now, expressed as the gap between what that money can buy today and what it could buy 12 months from now. The standard advice, hold 3 to 6 months of expenses in a savings account, was built for a different rate environment. Between 2009 and 2015, the federal funds rate sat near zero. Savings account yields and treasury yields were functionally identical. The friction of moving money into a short-duration instrument produced almost no benefit. So the advice was, keep it simple. Keep it liquid. Keep it in one place. That advice made sense at the time. The spread between a savings account and a 4-week treasury bill was measured in hundredths of a percent. The single account model was not wrong. It was appropriate for its conditions. Conditions changed. The advice did not. That is not a failure of the people giving the advice. It is a structural feature of how financial guidance propagates. Frameworks built in one environment persist into the next because they are embedded in habit, in bank onboarding flows, in every beginner article published between 2010 and 2022. The model is outdated, not broken by design, obsolete by circumstance. There is a difference. Tier 1 is 1 month of core expenses. Not total monthly spending. Core expenses only. Rent or mortgage, utilities, minimum debt payments, insurance premiums, and groceries estimated conservatively. Exclude dining, subscriptions, entertainment, and variable discretionary spending. For most people earning between $50,000 and $80,000 annually, this amount lives in the highest yield checking or savings product you can access with zero notice. A high-yield savings account, a deposit account that pays a higher than average APY, typically available through online banks, currently yields between 4 and 5% annually. At 4.5% on $2,500, the annual yield is $112. Against 3% inflation, the real yield is positive 1.5%. That is the first significant structural difference from the standard model. The function of Tier 1 is not growth. It is zero friction access within 24 hours. Job loss this morning. Medical bill tonight. Tier 1 covers it without liquidating anything. Tier 2 holds the remaining 2 to 5 months of the emergency target. This is where the yield spread becomes meaningful. 3 instruments are appropriate for Tier 2. The first is Treasury bills. A 4-week T-bill, a short-term debt instrument issued by the federal government, repaid with interest at maturity, currently yields approximately 5 to 5.25%. Liquidity timeline. 4 weeks to maturity, or sold early through a brokerage with minor price risk. Risk factor. If you sell before maturity, the price fluctuates slightly with rate changes. The second instrument is a money market fund. These are funds that hold short-term government securities and pay a yield that tracks the federal funds rate closely. Current yields sit near 4.75% to 5%. Liquidation is typically 1 business day. Risk factor, not FDIC insured, though government money market funds carry minimal credit risk in practice. The third is a short-duration bond ETF, a fund holding bonds maturing in 1 to 3 years. Current yields range from 4 to 5% depending on composition. Liquidation is same day through a brokerage. Risk factor, net asset value fluctuates modestly with rate movements. None of these are investments in the conventional sense. They are yield-optimized holding positions for money that needs to exist, remain accessible, and lose as little purchasing power as possible in the meantime. If this is already changing how you think about the money sitting in that account, the subscribe button is right there. This is what we do on this channel every week. 3 inputs determine how to split the emergency fund across tiers. Input 1, monthly fixed expenses, rent, utilities. Minimum debt payments. Nothing discretionary. This is the number that defines Tier 1. Input 2, job stability score. Rate your situation from 1 to 5. A 1 is a contract role in a volatile industry with no severance and high replacement difficulty. A 5 is a tenured position in a low turnover field with structured severance and high portability of skills. Your stability score translates directly into target months of buffer. A score of 1 or 2 warrants 6 months total. A score of 4 or 5 may be sufficient at 3 months. Input 3, the current yield spread between your HISA and the best available T-bill rate. If the spread is under 0.5%, tiering produces minimal mathematical benefit. The friction of maintaining a brokerage account and laddering T-bills is not worth $50 annually on a $5,000 balance. If the spread is above 1%, meaning your HISA pays 3% and T-bills are at 5%, the annual gain on that $5,000 Tier 2 balance is roughly $100. Over 5 years, compounded, that is meaningful without being transformative. The formula does not produce a single correct answer. It produces a range with a floor and a ceiling. Below the floor, you are underprotected. Above the ceiling, the marginal yield gain is not worth the operational overhead. Your number lands somewhere between them based on your 3 inputs. Here is the part most people never calculate. The standard emergency fund advice, 3 to 6 months, was derived from unemployment data, not expense data. The original heuristic was built around average job search duration, which historically ran between 3 and 5 months. The savings target was a job loss buffer, not a general emergency buffer, which means the standard model already conflates 2 different risks: the risk of income interruption and the risk of unexpected large expenses. A car transmission, a medical deductible, a broken furnace. These do not require 3 months of expenses. They require access to a specific dollar amount on a specific day. When you separate those 2 risks, income replacement and expense shock, the tier system maps almost exactly onto them. Tier 1 handles expense shocks. Tier 2 handles income replacement timelines. The design was always implied in the original advice. No one made it explicit. If you are starting from a standard savings account with 6 months of expenses sitting in it, the first move is not to restructure everything immediately. It is to calculate the 3 inputs: your fixed monthly expenses, your stability score, and your current yield spread. If your HISA is currently yielding over 4% and T-bill rates are above 5%, the spread justifies moving Tier 2 funds into a brokerage. If you do not have a brokerage account, opening one, Fidelity, Schwab, or similar, takes under 15 minutes. Buying a 4-week T-bill inside that account takes under 2 minutes. The gap between your current setup and a tiered system is not a project. It is 1 calculation and 2 account actions. The math exists whether you run it or not. Running it just makes the outcome visible. The single account emergency fund is not a failure of discipline. It is a framework that was correct in one rate environment and has not been updated for the current one. The loss has been happening quietly in accounts all over the country because no one handed anyone the calculation. You have it now. Watch the next one. We stay in the math.